You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is David Smith. He's the senior analyst for the Morgan Report, which you can find online at silver-investor.com. Welcome to the show, David.
Good to be back, Jim.
Some interesting numbers here. We were taking a look at mining stocks compared to a year ago, and also the prices of our precious metals compared to what they were at a year ago. I could see how somebody could be pretty depressed, but you're saying we have a good strategy if we put things together and some tactics to deal with some of these new lows for mining stocks. David, maybe outline what you think is happening now and the opportunity somebody would have in what you think might be a very narrow time gap.
I think that we're in the process of the last leg down in the metals, and I think they're going to bottom, if they haven't already, and they may not have, but I think they're going to bottom in the order of palladium, gold, and silver. I think when the turnaround comes, that's where you'll see the strength move in that continuum. Now, this process maybe take a couple of weeks. It may take several months. My sense is it'll happen sometime over the next few weeks. And it won't be apparent maybe until after that the bottom is really in. There could be a period of sideways trading or a retest later this summer of whatever the lows are. The potential exists for a serious leg down in the metals, and if it occurs, you want to be able to participate. Now, if the lows are in, that's fine. We're in good shape if we have our core positions, but we don't know what's going to happen. No one does, and we have to prepare for the worst and expect the best. And if we can see that in our mind's eye and see what the worst might be and say, okay, I can survive that and I want to participate, then we move forward with the plan. And so my strategy that I'm looking at is to hold on to my core, the positions that I know are good miners that aren't going to go away, even if I bought some of them at much higher prices. And I want to look at the charts, the technical analysis, which charts don't always tell you exactly what you think they do. But as Dr. Alexander Elder said, who is a tremendous chartist, has written a number of books on the subject, he says, quote, chart formations are the tracks left by bulls and bears, end quote. And so we look at these charts and we watch and see what's happening with the price, and we look and see if money is flowing into a particular stock or an ETF, and there's a money gauge that you can look at on these technical analysis. We look at the volume. Is it increasing or decreasing? So, for example, if prices are dropping and the volume is low, that may mean that most of the selling is dried up. But if the volume is high, it may mean that it's a selling climax, and we start to watch for a turnaround in prices. And we also watch something which we don't have time to discuss fully here today, but I want to alert people to it if they're not following it, and that's called MACD, or MACD, and that stands for Moving Average Convergence Divergence. You want to see if that confirms the prices. And if you go look that up, you'll get a complete description of what it is, and you can see it on the charts. But just remember, it is an important tool, in my view. Also, another chart formation that I like to watch for is one that doesn't happen very often, but it's called an island reversal. And it can be very important in a heavily traded market if you see one of these. And I'm going to oversimplify it, but here's the situation. On day one of a price, the stock trades at $5, and it closes and doesn't trade below that. The next day, it gaps down and it trades at $4, and it doesn't trade above $4 that day. And so what you have is a price area between $4 and $5 where no trading took place. Then on the third day, it gaps back up again, and it doesn't trade below $5. So what you have is that yesterday there was a gap on either side of the price day 2 and day 3. Now, if that's valid, and that often is a selling climax, if it's at the bottom where we're looking to be watching now, it can happen at the top too in the reverse order, then those gaps will not be closed. So in other words, prices will move away, in this case up, from the gap that was created, and you'll know within 2 or 3 days if that's valid. If it's not valid, it's usually closed within just a few days, and we look for another chart formation. But I watch for these. They don't happen very often. But I also notice in the case of these mining stocks, sometimes you'll see it on a number of stocks. And if I see that, that gives me great confidence in the possibility of a bottoming action that could last for months, if not years. So I want to alert people to the idea of the island reversal. They can also look that up and learn more about it. So, Jim, those are some of the technical things that I'm going to be looking for in this, what I believe will be the final leg down, whether it's a quick one over a period of weeks or whether it's protracted over a series of months. I still believe that we're in that bottoming process, and I do think it'll be a little quicker than most people think, but maybe not as quick as any of us would like.
Speaking about risk factors, anything new on Barrick's Pascua Lama mine on the Chilean-Argentinian border?
That's an ongoing thing. I saw a class action suit that was filed in New York, I think, earlier this week, and I didn't read it too carefully, but I think it has to do with shareholders that are disappointed in the price over the last few years of Barrick because they feel that maybe Barrick didn't disclose everything to them and maybe they wouldn't have bought the stock. But Barrick has been hit on several fronts, not just the Pascua Lama issue about whether they even own it or they can open it because of environmental concerns, but also a kind of a shareholder revolt. So they've got a lot of things on their plate, and it'll be interesting to see how it plays out given that they are one of the world's largest gold miners. But I certainly wouldn't personally be touching that stock with a stick right now.
Well, they've put $4 billion into this gold mine on the Argentinian-Chilean border, and for people not familiar with the issue, Aboriginal people in the area felt that their environmental rights were being violated, and a court has agreed that, at least on the Chilean side of the development, they do have major concerns, and millions, if not billions of dollars are at stake here.
That's true, and this is going to take probably several years to work out. It looks like at the very least it'll be delayed if it opens at all. But looking back at our tactics here now, if we believe that the bottoming process is underway, which I think we're seeing things get underway even as we speak today into this weakness, we look at the miners that we have fully researched. We don't go out and buy a bunch of new stories just because we see a press release. We make sure the ones that we have a lot of confidence in, and we might want to add to those positions, but we do it in a larger price range than normal. This is a mistake I made in 2008 when I was buying Goldcorp, for example. I bought down in $2 increments. Well, as it turned out, that was a major, major decline across the sector. I should have been buying in $4 or $6 increments, and I would have bought at much lower prices, and I would have run out of money later rather than sooner. So buy in a larger range than you expect to do. And then also, another thing that you can do is you can look at where prices are now for a particular stock you're following and compared to the 2008 lows, which were an extreme, and you can assume that those lows will not be exceeded or not by much. And if you buy halfway between now and there, that could be a good risk reward for you if you are buying a stock you have a lot of confidence in. And then finally, I would only buy into weakness, not into strength, because you're going to see some days where the price goes up and you think, oh, the bottom's in. Well, it may be, but then again, it may not, because within a day or two or three, it could give all that up and more. So if you're buying into weakness, your dollar cost averaging will take you down and give you a lower cost overall. And then finally, this is a technique that people have to use carefully, and some people may not want to, but I think exchange-traded funds, if handled carefully, offer you a real interesting tool that did not exist in the last bull market. ETFs can be a basket of mining stocks, for example. They can be based upon the price of gold and silver or palladium. And so you can go in if you want to look specifically at the price and you don't want to take a particular miner, you can buy a basket of miners. You can also use leveraged ETFs, which I call double-edged swords because they cut both ways. Some of them move 2 or 3 times as fast as the underlying stock or the underlying metal. And if you do your research on these and utilize some of these, they can help you more safely get onto the turn if you understand their risks and rewards. And I'll just throw a few out for people to research on these ETFs. There are hundreds of them, but I focus on just a few. There's GLDX, which is a global miners ETF. There's GGGG, which we talked about a week ago. It's a new one. The volume is still low, but this is the one that deals only with miners that have like 90 or 95% of their income from gold production. There's SIL, which is a global ex-silver miners basket. And then there are leveraged ETFs such as Nugget NUGT, which moves 3 times as fast as the index of the underlying miners. USLV, which moves 3 times as fast as silver up or down. And AGQ, which moves twice as fast as silver, and finally an ETN, which is a variation of an ETF called, I believe it's DGB, I'm almost certain on that, and that moves 2 times as fast as gold. So if you have those tools on your plate, you'll have more than enough to have a lot of fun with and hopefully profit from if you handle them carefully, just like you would a sharp tool.
The worldwide automotive industry has been doing great. Ford and General Motors also doing very well. We know they need palladium and platinum for their catalytic converters. I thought perhaps the prices there would be going up a little bit sharper because of that. Or have the major automakers been stockpiling those 2 particular metals?
Well, I haven't seen figures on what they've been doing, but I'm sure that they're buying a little bit more than they need, to say the least. What's very interesting, and David Franklin of Sprott Assets talked about this a few days ago, there's an ETF that's now been formed in South Africa, which is where the majority of the production of platinum and palladium takes place. And this ETF has already taken almost 400,000 ounces of platinum off the market, which is amazingly quick growth in a very short period of time. And this is going to have another effect, further effect of taking more and more physical off the market, even as the production declines. So I think platinum and palladium are going to be very exciting to watch. And even though, for example, they're weak today, I think they'll turn around and surprise people. And they've also been stronger than gold and silver. And that's my premise is that when the markets bottom, if they have not already, that you'll see platinum and palladium move first, and then gold, and then finally silver is what I would expect in the order of strength that we'll see coming back into the markets. The risks are large here for all of these vehicles, but the rewards are commensurately large in my view, and it's worth taking a serious look if you need to add to your position and if it fits your financial situation and your temperament. And so I think it's scary, but it's also potentially very profitable if we can get it right on an individual basis.
Well, I know J.P. Morgan described the current markets in the past week or so as scary. And I think if you know what you're doing, those are probably good times to take a look at what's cooking out there in the market.
Several years ago, when I was driving along the lower mainland in Canada, going to a Vancouver conference, I listened to a motivational speaker on a Canadian station. And he said all things in life have 2 elements. They have fear and they have excitement. Anything that's really worthwhile will be exciting and it'll be scary. And so I think if we have a plan as individuals and we work our plan and we know ourselves and we understand the tools that we're using and the sense of the market, I think it can be something which can be really rewarding, not just in a dollar sense, but also in a sense of following your principles. And I hope to be successful in this market and be around for the time when the public mania takes place, which I believe will happen in a few years, when you can't find anybody that isn't trying to buy the miners in gold and silver. And I think that if I'm successful, it will be because I have followed valid principles. And so that is exciting to me, and it's scary, and I'm trying to keep the 2 emotions in control so that I keep the wheels on and I can get there to the finish line.
You've always said don't let yourself be overwhelmed by your emotions when you're trying to make a smart trade.
You've got to control your emotions. Either you control them or they will control you. And that's why the things we've talked, the idea of scale-down buying, of buying into weakness, of never committing everything to one stock or one price point, these are all things that help you dial down the emotions in the markets, which are just, that's all they are. They're emotions all over the place. And if we are in this process of the final leg down, or however long that takes and however violent it is, if you can keep your head when other people are losing theirs, then you're going to be a market winner.
And in today's market, it takes a good head to stay ahead.
It certainly does, Jim.
Well, David, thank you very much for taking part in today's show. My guest has been David Smith, the senior analyst for the Morgan Report. You can find the Morgan Report online at silver-investor.com. You're listening to HowStreet.com radio. Find us on Twitter at TalkDigitalNet. You can contact us at info@HowStreet.com. I'm Jim Goddard.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.